Daily Brief Canadian Macro with your host, Steve.
Welcome back to the Daily Brief Canadian Macro. I'm Steve. U.S. investors are sitting on historic cash lows while stock interest hits all-time highs, and one prominent macro analyst is positioning defensively because of it. Today we're covering two big topics: a major call on North American equity positioning and what it means for Canadians, and what to expect from the new Fed chair's rate decision. We'll hear from John Zechner at BNM Bloomberg and get insight on Kevin Warsh's hawkish tilt at the FOMC from Gennadiy Goldberg. Let's dive in. John Zechner laid out a detailed outlook on North American large-cap stocks, and despite record market highs, he's advocating for a defensive rotation because valuations are elevated and sentiment has gotten ahead of itself. U.S. cash levels are at historic lows, and public stock interest is at all-time highs, which from a contrarian perspective signals dangerous positioning. What's holding the market up is narrower than it looks: roughly $1 trillion in AI and data center capex, a deficit to GDP ratio near 6%, and wealthy household spending off the back of strong portfolios, while everyday consumers quietly absorb higher gas and food prices. So Zechner's strategy is to rotate out of consumer discretionary, financials and tech exposure into yield-supported energy, infrastructure, pipelines, and telecom. One specific insight: he's adding to Canadian engineering firms like Atkins Realis and WSP Global, which trade at low teens EV multiples. He sees AI displacement fears as unfounded and views them as a genuine value opportunity. On the Canadian bank front, Zechner flags something worth your attention. Canadian banks' forward multiples have extended to 13 to 15 times earnings, up from their historical range of 10 to 12 times, and he attributes that rally to capital market tailwinds. But here's the concern: those tailwinds likely won't survive a recession. Zechner makes a claim that loan loss provisions are increasing, which he says makes current valuations suspicious. However, a look at the data over the last year shows all of the big five Canadian banks have actually been decreasing their loan loss provisions rather than increasing. Zechner also highlighted Rogers Communications specifically. Recent capex cuts will drive significant free cash flow gains, enabling higher buybacks and dividends. He noted the company delivered 26% total returns from defensive positioning a year ago. On the semiconductor side, Zechner sees NVIDIA's 90% dominance as creating margin compression risk, and while the stock's 20 to 22 times valuation looks cheap only versus peers, when capex slows, valuations could compress dramatically rather than quickly. Three new positions Zechner mentioned stand out. First, Sprott Physical Uranium. He frames this as a supply-demand structural play with a 5 to 10-year minimum appreciation timeline. Second, North American construction, trading at a discount to peers on operating cash flow. And third, Salesforce at 12 times earnings with 10% plus growth. Here's the interesting part on Salesforce. Zechner argues software vendors must transition from seat-based licensing to outcome-driven agentic models to defend against AI disruption. He points to Salesforce's Agentforce, which improved automated response rates from roughly 25% in 2023 to over 70% today, and he sees that as a defensible competitive advantage. The reason that matters is it suggests enterprise customers prefer established vendors to manage AI integration rather than build in-house, given the risk and complexity involved. Zechner's whole thesis hinges on one question: what happens when the Fed stops cooperating? And this week we find out. This morning, ahead of the decision, Gennadiy Goldberg told BNM Bloomberg his view going in was simply a hawkish tilt. By the afternoon, what actually came out was more hawkish than even that preview. The Fed held its benchmark rate steady, but 9 of 18 officials now project the rate finishing 2026 above where it sits today, and the committee's median projection jumped to 3.8%, up from 3.4% back in March. Warsh himself didn't submit a rate projection at all. He told reporters it wasn't a useful exercise for him this early in the job. In a signal of how he plans to run things, the Fed also dropped forward guidance from the statement entirely, calling the language intentionally brief. Markets didn't love it. Stocks slid into the close, 2-year Treasury yields jumped to their highest level in over a year, and the US dollar had its best day in months. For Canadian investors, that's the part that matters most. A Fed leaning hawkish and holding rates higher for longer keeps pressure on the Canadian dollar and narrows the room the Bank of Canada has to work with on its own path. Warsh also announced a new task force to review the Fed's communications, balance sheet, and inflation framework, which keeps his AI as disinflation theory in play. If he can eventually make the case that AI keeps a lid on prices, that gives him room to argue for a higher neutral rate, or R star, without needing to cut rates to get there. That's a multi-year question this meeting didn't settle, but it's exactly the kind of rethink those task forces could take on. Zechner is positioning defensively because narrow tailwinds and stretch sentiment outweigh the headline strength, though it's worth saying he's held that view since the spring while the TSX kept grinding to record highs anyway. Warsh's first meeting came in more hawkish than even this morning's preview suggested. The median dot moved up to 3.8%, and forward guidance vanished from the statement entirely. Put those together, and Canadian investors are looking at stretched equity valuations and a rate environment that just got more restrictive, not less. Zechner is still finding pockets of opportunity. Yield-supported sectors, engineering firms, software vendors adapting to AI. Selective, but not bullish. Selectivity and downside protection, not broadened participation, seems to be the theme this week. Well, that's the end of tonight's episode. Thanks for watching the Daily Brief. All credit goes to the creators featured today for their original analysis and insights. You can find links to their full videos in the description below. If you found this market summary helpful, please subscribe, hit that notification bell so you don't miss our next brief, and don't hesitate to comment if there's a creator or topic you'd like us to cover here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.